Holy smokes, everyone. What an absolute wild day it was in the markets today. And things are changing very, very quickly for the worse. We have mass layoffs on Wall Street and also on Main Street. We've also got some new data that tells us what is going to be happening in the economy and what's going to be happening in the jobs market. And this absolutely terrified the markets today. And not just the stock market in general, but specifically the banks are taking another hit. And like I've been trying to warn about everybody, this banking crisis is just the beginning. In 2008, it went on for 4 years and there were hundreds of banks that failed. So people think that, 3 or 4, that's pretty bad. They haven't even seen how bad it can really get. And I'm not trying to say this to scare everybody. I'm trying to say it to warn everybody so you can be prepared because many people aren't ready for what's coming. So everyone, what exactly did happen in the markets today that spooked the markets? What new data, what new information do we have that tells us what is going to be coming ahead? Well, that's exactly what I'm going to go over in today's video. So let's not waste any time, ladies and gentlemen. Let's get straight into the news, the facts, and the data. Okay, everyone, first things first, look at this. Dow tumbles more than 300 points as banking sector worries reignite before Fed rate decision. So that's another thing worrying the markets right now. A lot of people thought the Federal Reserve was going to pivot right now. They were going to turn the money printers back on. They were going to drop interest rates to zero. We're going to have another raging bull market. But no, people, like what we got yesterday, where I'm from, Australia, we got a big surprise. Well, it's a surprise for most people, but not for me, and I'm sure not for you. The Reserve Bank of Australia actually lifted interest rates by 25 basis points, 0.25%, when there was like a 90% chance that they would pause. But people, inflation is still not done. The job isn't finished on inflation. And the thing is, what happens with inflation, if you say, well, look, inflation will go back down on its own. We can pause now. We can stop lifting interest rates now. No, inflation will come surging up again. You need to finish it off once and for all. Otherwise, it's going to come back up again. And then you're going to have to lift interest rates even higher that will bring on even more economic pain. Listen to what happened with the banks today, everybody. Bank shares slid with SPDR, S&P Regional Banking ETF, dropping more than 6%. That's right, the regional banking ETF is getting hammered. So that tells us a lot of the smart money they're running. Traders question the stability of the smaller regional financial institutions after the crisis that engulfed Wall Street in March and brought about the end of Silicon Valley Bank and First Republic. And regional bank PacWest, which could be the next to go, and Western Alliance as well, declined 27% and 15% respectively. So this is not financial advice, but if I was a customer with PacWest and Western Alliance, I'll be running to the bank right now and I'll be withdrawing every dime I could. But it's not just the small regional banks that took a hit today, also the major banks did as well. Meanwhile, JP Morgan Chase shed 1.6%, giving back some of its gains from the previous session. A day earlier, JP Morgan rose after the takeover embattled regional First Republic Bank. Other large banks, including Goldman Sachs and Citigroup, also dropped more than 2%, and Bank of America, which again, people, the Bank of America is the major bank that has the most unrealized losses. They're one of the big 4 banks that has the most unrealized losses on their books. So I'd also be worried if I was a Bank of America customer. They said, we think the concerns around the bank sector combined with uneasiness regarding the debt ceiling and most importantly, apprehension over the uncertain future Fed rate policy stance are all contributing to the risk off sentiment. So in an area like banking sector that was already under stress, we're also seeing greater unease because of all these contributing factors. That's another thing happening, everybody. What people don't actually realize is the US government is bankrupt. Just thinking of it like this, if you or me had to keep on increasing our credit card limit just to repay back the credit card and to also buy groceries, etc., we would consider that we're on the brink of bankruptcy. If we had to go to the bank and tell them, look, I can't pay back this credit card, so how about you just give me another credit card? The bank will say, no, we're not giving you any more money whatsoever. But for some reason, people think that the US government can just keep on borrowing to infinity and there's going to be no consequences. No, there will be consequences, everybody. Eventually, people lose faith in the US government. They'll stop lending them money. Other countries will stop trading with the US. And we're seeing the rise of the East right now. They're starting to see more trade trying to be done in the yuan. We're seeing the rise of the BRICS nations. So it won't happen anytime soon, as I mean a year or two. But I think by 2030, like the Great Reset said, the US dollar could fall from its world reserve currency status. Because listen to this, Treasury Secretary Janet Yellen warned on Monday that the US may run out of measures to pay its debts as early as June 1st, earlier than the late July deadline Goldman was estimating. So it's absolutely crazy that we have to do this song and dance. We all know that they're going to increase the debt limit, but what is worrying is the debt limit is starting to be hit more and more frequently, and it may come to a time when the debt limit is going to be hit every single month. But this is just the tip of the iceberg, everybody. There's a lot more unease in the markets today and a lot more market reactions that we have to go over. So first things first is this, everyone. Brent crude got absolutely hammered today, falling over 5%. And what normally triggers Brent crude to fall is if people think that there's going to be weaker global growth. And there is going to be weaker growth. The US, the biggest economy in the world, is going to fall into recession. And so this is oil traders realizing there's going to be a lot less demand for oil once we enter a full-on depression. Also, gold and silver, we can see up here, gold went up 1.7% today, and it's back over $2,000 an ounce. So what we're seeing right now is we're seeing a flight to safety with gold, silver, and also bonds. But something surprising that has happened over the past quarter, this year really, since the banking crisis has happened, we're seeing actually people go into Bitcoin as another way to get out of the financial system. Now, while I was bearish on the price of Bitcoin and I predicted that it would crash below $20,000 a year ago, and a lot of people thought it was crazy, but there is a utility for Bitcoin, and that is, for example, you can take your money out of the bank, you can put 500,000, a million, etc. in Bitcoin, you can take it off the exchange, you can store it in cold storage off the internet, so if the internet goes off, your Bitcoin's still there. The only risk you have is if it falls in value, but this is just another way, like gold and silver. I'm not telling people to go all in Bitcoin. I'm just saying it's been interesting to see as the banking crisis gets worse, Bitcoin price goes up because people were worried that maybe the whole system could go down. And if it did, at least they would have their Bitcoin in cold storage that they could use to barter with. But people, the biggest story that we have to pay attention to right now is what's happening in the jobs market. We just got news that there's mass layoffs happening on Wall Street, and we also got some new economic data for what's happening with job openings. So you need to really pay attention to this because we're already in a recession, but this will predict if we're going to be facing a depression. Listen to this. Wall Street is cutting more than 3,000 jobs as Morgan Stanley plans 3,000 layoffs. That's right, everyone. The banks are in big trouble. They're losing lots of money in deposits and they're trying to please shareholders and they're doing mass layoffs. As Wall Street slump in IPOs and mergers deepens this year, top advisory firms, including Morgan Stanley, but not just them, Bank of America and Citigroup have turned to job cuts in recent weeks. So this equates to roughly 5% of the New York-based bank workforce, excluding the financial advisors and support staff who will be spared in the cuts. The person said the layoffs are expected to impact banking and trading staff the most, according to Bloomberg. And so for Morgan Stanley, the cuts show Wall Street is wrangling with expenses as slump drags on for longer than expected. The bank already cut 2% of its workforce in December, CNBC reported. So that's right, everyone, why they're trying to tell you the banking system is sound, the economy is great, while companies on Wall Street, big money, is doing the opposite. Because there's a perfect storm happening for the banks, and that is rising costs and falling revenue. Last month, analysts criticized Morgan Stanley for posting higher first quarter costs while revenue declined. Expenses in the firm's investment bank and wealth management division hurt profit margins in particular. The bank's moves aren't isolated. The industry job cuts began in September when Goldman reinstated a practice of culling those it perceives to be low performers, and nearly all major Wall Street firms followed, and Goldman itself had to resort to another round of deep layoffs in January. But people, what you have to know is it's not just these high-paid banking roles. We're seeing mass layoffs across the board. Look at all these other companies that have announced layoffs already this year. So look at this. David Bridal lays off 84% of its workforce as of April. Roku lays off 6% of its workforce as of March. Lucid Group lays off 18% of its workforce in March. Meta, they've laid off 13% of their workforce after all the layoffs in 2022. Twitter, they've announced another round of layoffs, 10% in February. We're seeing Disney, 3% of its workforce, February. Zoom, 15% of its workforce. PayPal, 7% of its workforce in February. Gemini, 10% of its workforce. Yankee Candle, 13% of its workforce. Spotify, 6% of its workforce. Google, 6% of its workforce. Microsoft as well, 4 to 5% of its workforce. Amazon, 2% of its workforce in January, and I think they've announced another 18,000 layoffs. Coinbase, 20%. DirecTV, 6%. Salesforce, 10%. Goldman Sachs, 8%, and the list just goes on and on. So the banks are in big trouble. Companies are announcing mass layoffs. The stock market's tanking, but we just got another forward-looking indicator to tell us that things are about to get worse. Look at this, everyone. US job openings fall, layoffs jump in sign of softer labor market. So the job openings dropped a third month in March to 9.58 million. So this is called the JOLTS report, the jobs openings report, and this is how we can see how many companies are hiring, because what normally companies will do, instead of first doing layoffs, first they'll halt hiring and then they'll resort to layoffs. So if job openings are going down, you better believe there's going to be more layoffs following. So we can see here the US job openings slide for a third month with this chart here. And it says the number of available positions decreased for a third straight month to 9.59 million from nearly 10 million a month ago. So that's 400,000 job openings gone in just 1 month. The Labor Department Job Openings and Labor Turnover Survey, or JOLT, showed Tuesday that it was at lowest in nearly 2 years and fell short of the median estimate in Bloomberg survey of economists. The data preceded Friday's monthly jobs report, which is currently forecast to show employees added 180,000 jobs in April. We'll have to wait to see what the real figures say. Economists are expecting the unemployment rate to tick up slightly and for average hourly earnings to rise at a similar pace as the prior month. So if you have a job right now, do everything you can to keep that job. Try to find a way to start a side hustle so you have another source of income, or maybe even another part-time job. Start saving as much as you can, because Bank of America is giving us another very serious warning. Look at this. A notorious recession indicator says an economic downturn will begin not this year, this quarter, Bank of America says. So what is this indicator, everybody? Let's have a deeper look. Strategists pointed to the inverted Treasury yield curve, namely the spread between the 2 and 10-year, and this is what I've been showing everybody and trying to warn everybody about. Short-term yields surpassing long-term yields are a highly watched signal of an incoming recession, with the inverted 2 to 10-year spread predicting the recessions of 1990, 2001, and 2008. Now, this is something I've been watching very, very closely, and this is something I've been showing you all, and we can see the yield curve has been steepening, but it's now taking another hit, and it has been inverted for a long time now. It hasn't gone back up. So this is telling me we're not just going to have a small recession, we're going to have a deep recession. The analysts say that historically a recession kicks off 6 months after the inversion of the 2 and 10-year curve. Given those bond yields inverted in November of last year, the recession should be arriving in May. And I'll just bring up the chart here. According to my chart, it actually inverted in July. So this is telling me we are already in a recession. But of course, the US may bring out GDP and say, look, the economy grew at 0.1%. Well, it doesn't matter if the economy grew at 0.1% or it fell 0.1%. Pretty much when you ask people on the street, it's going to feel the same for them. And when inflation's so high, even if we get growth for the year of 1%, when you factor in inflation's 5%, in real terms, the economy is in a recession and we are facing a stagflationary recession. The 2 and 10-year yield curve recently notched its deepest inversion in over 40 years. That's right, everybody. This is not just a small inversion. This is the steepest inversion in 40 years, and this tells us we're going to have a huge recession worse than 2008. The inversion steepened in March as the collapse of Silicon Valley Bank unfolded, a move that market can interpret as a major omen for the US economy. And you know what's very, very spooky and very, very worrying? This came out before the jobs market came out, this report I should say, and look what confirmation we have now. Yield curve says recession start now. Markets await confirmation from the labor market. Well, what did we just get, everybody? We got confirmation that the labor market is deteriorating rapidly. Traders said in an email note on Friday, inverted yield curve signals recession, but once recessions begin, the yield curve immediately steepens as markets discounts Fed policy response to recession, they added in the note. But there's one more big warning. The higher rates that the Federal Reserve has created are expected to continue weighing on employment and corporate earnings, which spells trouble for stocks, which is what we're seeing again now. Though equities are pricing in just a 4% decline to corporate earnings, I think it's a much higher chance than that. There's risk that the firms could face bigger headwinds amid higher rates and recession on the horizon, the bank said. They're staying bearish as economic indicators for 2023 are set to end with a crack in the labor market and EPS recession, earnings per share. Well, since this report has come out, Bank of America has been spot on, and everything they're warning about, everything I've been warning about is playing out to a T, everybody. So, I know we're thinking, well, okay, what does all this economic jargon mean for you in simple terms? This means you need to prepare right now for recession. You need to prepare for possibility of you being laid off. You need to make sure you're one of the top employees at your workplace, or try to find a better job if you're not happy with where you're working at. Try to start a side hustle, get another part-time job, or hopefully you have an emergency fund. Try to find ways to pay off debt. So even if you do get laid off, you can survive 3 to 6 months. What this also means, I don't think we're in a bull market right now. I still think the markets are being irrational. I still think there's a lot of speculation going on. And once reality hits, we are in a deep recession, they're going to take another nosedive. But everyone, this is just my opinion. What do you think? Let me know down below. Now, for all my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you all in the next video.